Hello, Trend.
Hello, hello.
How are you?
Good, good. How are you?
Good, good. Yeah, I'm doing well, buddy. Doing well. We'll let a few folks kind of come in here, and we'll kick her off. Hope everyone had a good day out there. As by by the record books, the history books, Trend, it was a pretty uneventful day. Down 7 bips on the SPX. It certainly felt a little bit more hectic than that, didn't it, buddy? Up.
Yeah, we had the triple central bank event, right?
Yes. Yeah. Exactly. Perfect. Other side, can you come up and do you want to come and join as a speaker, or I'll invite you if you can. I know sometimes you're at gymnastics and stuff, but awesome. Well, we'll kick it off here. Welcome everyone again to another weekly notebook review. This is June 29th, and yeah, looking forward to kind of getting into it. We got Q2 here is about to wrap up. One more day in on the horizon for June of 2022. So we'll kind of be reviewing a little bit of what we've seen, this quarter, and then obviously, the big question marks is what are we going to be anticipating and or kind of looking for both in the near term and longer term. I know for many, you guys hopefully got a chance to watch the Q3 macro update out of Hedgeye and Keith McCullough and the Stein bomber. So yes, if you've got that, obviously got a bit of a leg up on everybody else, but we'll be, not going to be diving into exactly what they can, discuss today, but obviously, some of those themes overlap, like the commodities, and he's been pretty vocal about that on both Twitter and in the RTAs. But kind of typically I'll pass it off to Trend if you're up for it, buddy, and kind of run down what you're seeing out there, and then I'll take the ball back.
Yeah, sure.
Yeah, cool.
So starting with my Asia longs, I think a few weeks ago I had mentioned about EWH. I continue to stay long on that. We'll be adding more with the classic buy the dip. Few other names on buy the dip are China Life, which is LFC ticker. Pinduoduo, I fed the ducks bit at higher levels earlier, bought it back again. KWeb, Baba, CQQ, Q. In the S&P 500, the ones on the long side are Lamb Weston, Dollar General, Brown Foreman, Monster, Vertex, and I've been playing broader, very tactical shorts. I haven't yet set up new shorts since last week from a standpoint of broader markets. I'm waiting for the right levels and also complacence to set in. From this is from U.S. equities perspective. I discussed my Asia longs on the short side amongst international EWO. I just wrapped up covering them today, which is Austria. We'll wait for it to set up again to go short again in Austria. That was a decent one for almost more than 10%, 15% almost. Also, we'll be waiting for a setup on short side for Sweden and Germany. From a standpoint of currency, I think we have Chris on, right? Yeah, we have Chris on. I'll let Chris speak about currencies, and if you have Gavin, then I'll let him speak about the rates. But broadly speaking, in currency, the only trade I did was on the Euro USD side, um, being short Euro. We'll be covering that soon. Um, Dollar was incredibly strong so that one I expressed through ETF UUP. Still long through some calls, 27 calls for September. And then last but not the least, on the rates, I actually didn't do much trades in the last week. I don't plan to for the next 1 week either, going into 4th of July, because there's no good setup there, at least not for me. So those are all my updates. Back to you, Rob.
Yeah, good stuff. I mean, I think on the dollar side, to me it was kind of a good day too. Um, feed a little ducks there, right? It wasn't quite at the top end of the trend range, and that's definitely putting in a great signal at 28.40 is the top end. So that's basically putting in a new high, new 1 month high, new 3 month high. So that's a great signal there. So the dollar still, is a great place to park some capital, whether that's expressed through UVP or just owning cash in the account, right? If you live here in the U.S. Or through
Yep.
the FX market, as you said, trend. So that's a good opportunity there. It had a lot of strength, and yeah, kind of the currencies definitely stood out to me as a place to be playing a little bit. But other side, you got anything jumping out of your notebook, buddy?
Uh, Not a ton.
Yeah,
I think levels are, uh, like Trent said, waiting for some levels. I did go, the past couple of days I've been getting more short. I put that out there, that I was getting more short. I just said size appropriately. Yesterday morning into the um, strength in some of the financials, among other things, I got more short in the morning, and that was a nice swing because we went negative. So I didn't really want to add anything today. I did add a little bit. I did add a little bit more to my shorts today on some things that were green. I'm just not. I'd like to be bigger, but I'd like to be bigger at better levels. So I'm kind of hanging around till tomorrow. I added more gold today. Uh, I was I was lower than I typically want to be. I do think that we're in a consolidation phase. I saw gold at around 1817, and I just picked up another 100 basis points of gold, which brings me up to 400 bips instead of 300 bips. So um, I still think that we have market end dynamics in play a little bit. Some people screwing around with some things. I did note yesterday on Twitter that I was out of all of my UVXY. As much as I think vol might spike, I didn't like the way that ETF was trading relative to what it's designed to do. And we've talked before about that, where if something isn't really working the way it's designed from an ETF standpoint, just the way I play it, I will cut first and ask questions later. Over a decade ago, 2008, I lost a good amount of personal money on not cutting when I should have. I had the right, in quotes, call, but so I just use it as a rule. That's just a personal. So I find a different way to express it, but it's just and that's really it. I don't know. What are you seeing, bud?
yeah, gold's a good call out. That was definitely on my list here to talk about. Obviously, the signal's kind of gotten a little bit weaker in the last month and a half or so, 3 months, but definitely hanging around there at the bottom end of the range. I think what you got to be careful about, and Chris sort of pointed this out to me the other day, is this basically it's pretty close to making a new 1 and 3 month low. So that level would be around. So on a 3 month basis, it's around 1808. So, that's
Yep.
the only thing that's got me a little bit hesitant, not hesitant, but just conscientious about it. At
Yep.
the low end
Yep.
of the risk range today, 1809, right? So it's kind of hovering right around. If it goes down there, that 1809 number is a new 1 month low, and that would be pretty close to pushing a 3 month low. So I do think, and I expressed this to a couple of folks who DM me, that that 3 to 4% position, kind of at min sizing, other side is spot on, right? If you don't have that on, I think you'd likely kick yourself in a month or 3 months time that you didn't take advantage of. Sort of, again, it's not really even picking a bottom. It's just sort of, to your point, other side, a bit of consolidation, bit of signal weakness, which is probably why coach hasn't officially hit the button yet. Plus, we got
Right.
a potential rates scenario happening in mid-July there in a couple of weeks with the Fed meeting, and again we saw big moves in that when that happened earlier this month. So that's likely what he's maybe waiting for, but definitely what I would, again, not investment advice, but I just, if you're looking at your book like other side just did, taking it to that kind of min level,
Yeah.
and again be practical about it, right? So put
Yep.
in a
Yep.
couple different like incremental limit orders, right, at different levels, 25, 50 bips at a time, and just be patient, wait to see if you got filled. I actually expressed that other side in buying a few longer dated
Calls.
gold, GLD calls, correct?
Yeah.
Yes, because I'm
Nice.
already I basically still have about 3 to 4% from back earlier this year. It's I actually looked at it today, and it was funny. It's probably about the only thing in my book that I still, well, that and some of the triple inverse stuff that I have basically back from like January. I saw the dates were like fills are January and February. I was like, oh, okay. But wrote it up. I've traded it around, and now down to that kind of 3.5% level. But expressing it, just from a price standpoint on some longer dated calls. So I have some
I,
limit
I
orders
think.
in on September, December, and then March of next year. And again, I got to give a shout out to my boy Chris, Thousand Air Effects, for putting those on my radar too.
Yeah, I think that's a smart play. If we saw more strength from the signal at the low end of the range, still above more mid to max, right? Under normal circumstances, right?
Correct.
Um,
Correct. Yeah, I
but
mean,
but
as long as the volatility, I think, coincides with that, right? So if that
right,
GBZ stays kind of, below 20, right, and we push that level, that to me is a clear sign. Yeah, exactly.
right. So that's that was one of the thought processes in terms of the sizing appropriately. Well, appropriate is
For sure.
all relative, right? But that's what I felt was appropriate given where we were with the signal and where we are with the range. I didn't see any, I don't see any yellow dots. That's an inside joke between Robert and I, but I didn't see any yellow dots, so I added a little more. To Trent's point, I also added some China on weakness. I bought a little bit of Golden Dragon. I have a little K-Web. I have a little KBA. I have some Pinduoduo, some Didi. When I say little bits, I'm just, little. I'm I'm nibbling. I'm adding to positions on little bits of weakness, but the collective is adding up to a little over a min position, a min starter. So I'm creating a basket of China. I'm not looking at it per se as a single holding from the standpoint of I want to get to a min on each particular holding. I'm creating for myself a percentage of China that I'd like to get to, and I'm over my min in that basket, and then we'll see what happens from there. So just a little different way to play it as to where I'm not necessarily saying, well, I'll go 6% or I'll go up to 6% KDA, right? I'm creating a little basket of China, and I think that's the best way for me to get my entry. And then as if we get some weakness in it, I'll keep adding incrementally along the way to get up to a solid position there, so long as the signal strength holds. So I think that was a good call out by Trend as well.
Yeah, agreed completely. It's just been, Coach, I think, joked about this the other day on the macro show. It just keeps going up and to the right, right? So,
Yep.
yeah, definitely.
I would highly urge everyone to look at LFC also. It's like a dual benefit one, because rates are helping insurance companies in general, and this is Chinese insurance company, right? LFC, it's world's biggest life insurance company, bigger than MetLife, bigger than Prudential. So definitely have a look. LFC was fiercely beaten down when China was not working in the right chords, but then now being in the right chords, that equity is just getting huge uptick and bid.
Yeah, I just pulled up that chart. It's like gapped higher like 5 days in a row. So just like any trader out there knows, those gaps are likely going to get filled back again. So you
Yeah,
could have a good opportunity to pick it up at $8, but
yeah.
yeah, if you're also a trend follower, aka trend wizzo, the one, the only, yeah, that's a good one to have in your book. That's for
What's that?
sure.
What's that symbol trend? I was driving. I apologize.
Sure, sure. Lambda Frank Charlie.
Thanks, buddy.
Yeah. I was gonna have to go to my cheat sheet there. That 1000 FX, aka the yeah, you sent me, but it's all right. Thanks, Trent. You got my back on that one. Cool. The other two things I did just want to talk about, and then we can kind of open it up to some questions or what have you. Just the volatility, right? So volatility is kind of coming in, or certainly, somewhat shrinking. I know it's still elevated, still at the top end of the chop bucket, but those risk ranges are kind of are narrowing a bit, which is causing, the risk ranges are tightening, and Coach kind of alluded to this in one of the RTAs today, and that's mainly because those ranges are kind of coming in, right? So I mean, today we had, call it round numbers sake, 27 to 30, 34 versus, last on the 23rd, so almost a week ago, of 27 to 36, right? So that top end of the risk range was just north of 36. So, the low end is kind of still sticking around the same level, slightly below that, but that top end's kind of coming in, which is bringing up that bottom end on the VIX, that is, the bottom end of the SPX, right? So they're kind of inverse, right? So that top end, that 34 number, if that drops down to 32, whatever, then that bottom end of 3600 and change is going to come up to, kind of move higher, right? So just kind of keep that in mind. It's definitely something that I've seen. You're seeing that with almost all forms of volatility. So, if you pull up a chart on RVX for the Russell, Vixen, VXN, GVZ. I did not have a chance to look at OVX, but I'll pull it up real fast. What does that look like? Yeah, right there at 48 and a half. All this vol, for whatever reason, and folks can, theorize about why volatility is the way it is. But I think you just got to deal with the game you're in, and what the market's doing right now. That volatility is getting a little bit suppressed. So who knows? Maybe it's going to be a ball that bounce comes back to the surface and explodes higher. But for right now, you just got to play the game that you're in, and so those edges are tightening up.
Yeah,
And then yeah, go ahead.
I apologize. May I? With that, and just as you're talking about with that, it's creating lower highs in pretty much all indices and tech complex, but also higher lows, right?
Yeah.
So that's just compression. So just good call out there. But that lower highs is something that Keith seems to keep writing in his coaching notes, right?
Oh yeah,
Lower highs, lower highs. So just
100%.
yep.
Yeah, no, exactly. And again, that basically means that, as of today, I mean, the the best pricing you could have gotten to short, right, is
Yep.
at a
Yep.
lower level. So
Yep.
again,
Yep.
like as you and Trend and even myself, like I don't have, I started kind of basically putting on some shorts, I guess maybe Friday or Monday, and I'm not even close to remotely to the level in which I wish to be in terms of a portfolio allocation standpoint, going into what I suspect and what many of us kind of have on our horizon as to a horrific kind of Q2 earnings season, right? And something that Mike Taylor's talked about, and obviously the guys at Hedge Eye as well, that's the expectation. So, so just keep that in mind, right? So like, the pricing that you might have had in your head on Monday, and it's something that I'm reminding myself, it might not be the same level that you're actually going to get to in terms of being able to put those kind of shorts back on, or puts, or however you wish to express it. Now in the interim, could there be some green days ahead? That's to be determined, but that's obviously, again, with this volatility, shrinking, it means it can get to that low end of the risk range down to, a little under 27, maybe it pushes back to 26, 24, and then that would be really, to Trent's point, that complacency. If we get back down to 24 and everybody's, hooting and hollering saying, hey, the bottom's in, we're going higher, that's certainly when I'd be kind of taking that contrarian view and putting on those shorts more aggressively again. I guess that was probably Monday, right? Where we had a big up day, right? Yeah, I guess it was Monday. Yeah.
Yep. Yep.
Yeah, that's when I see Rob on here. That's where the invitation homes and all that kind of stuff. But again, with the RTAs, right, you can see that the list has shrunk on the short side. Coach covered a lot, and again, it doesn't mean that we're going to boom higher, but just be cognizant and be nimble out there in terms of covering some of those shorts, taking what the market's presenting to you, because all of a sudden 2, 3, 4, 5% profit could turn into a negative real quick, and you could really, again, we're in the chop, right? So being active, if that's your game, being active is the name of the game. Patient and wait for kind of that extra day in terms of like when you think it's the top, give yourself another 24 hours and throw her on. But the last thing that was on my notebook that we haven't really discussed a lot of was commodities. Yep. And just that the commodity index itself, CRB, losing a lot of signal strength. It's obviously, Keith's been pretty vocal about it today and on the call, on Macro Show, on the Macro Pro deck, et cetera, Twitter, pretty much everywhere. But commodities, short commodities is kind of on the horizon. And to me, the two weakest right now that I just would want to put on everybody's radar would certainly be copper and uranium. So CPER would be one way to express that, and then URA. Those are two pretty common ETFs, that kind of thing. Another way to express copper would be through Freeport McMoran. So FCX, you can kind of just short that outright equity, and you get a double whammy of obviously, copper exposure as well as U.S. equity exposure. But yeah, just smoked. Yeah, smoked, right? Yeah, exactly. So those CRB definitely losing signal strength. Interestingly enough, though, the oil still kind of has a decent signal strength. So BNO, USO, they've kind of regained strength here recently in the last few days. So again, it'll be interesting to see kind of how that plays out. And from a longer term perspective, the longer oil stays elevated, the worse it is for the consumer. The worse it, basically the more inclination the Fed's going to have to raise rates and kind of keep try to combat inflation in that manner. So it all kind of ebbs and flows with each other, and you got to be paying attention to kind of everything. But obviously, just make sure you're focusing on the stuff that's important to you and how you position your portfolio and play your game. Awesome.
Hey, Robert.
Yeah, man.
Can you want to chat about something like a Bed Bath and Beyond, or you want to table that for later? Something, talking about like more of the earnings recession type stuff, or you want to table that for later?
Yeah, we can do that. We can do that. I mean, I don't know if I have much of an insight other than what was kind of mentioned on the call, and obviously the stock was down like 20, or I think it closed 12%, maybe something like that. But
yeah, I mean, less about a Bed Bath and Beyond per se, but more about those surprises. The down 82, the anticipated down 82 million or $82 million loss versus a $224 million loss. I mean, those
it's a big number.
Those surprises are monsters. I mean, that's crazy.
Yeah. Again, I mean, not who would have thought, but sometimes you look at the chart, right, and you see it's gone from 30 to even in just the last I guess 12 months or whatever, right? It's gone from 30 to 6, 6.5 ahead of that print, and then down another 25, right? So it's like there's still downside to a lot of these equities. And I know we got Rob on, and I think every Monday he tweets out that MPW is about X too many dollars away from zero. So it's not just that one. It's many, and it goes across the universe, right? In terms of again, the list is long, but yeah, no, I mean this is going to be a problem across the board. So trying to Rob's actually coming on. Mr. Simone.
Hey, Rob, what's going on? Every day that MPW is above 1 penny is 1 penny too high.
It's one of my favorite tweets now that I look forward to
every day, like literally every morning. I
every day, yeah, every morning. Yes, so currently at $15.94, I believe is where it closed. So it is currently $15.93 too high.
Well, one thing to watch on it, and actually a client flagged it for me today. It's a big unsecured borrower. its bonds have just absolutely gotten smoked over like the last 3 weeks. Um, even during this like little bear market rally, over the last like week and a half or so. But
Mm-hmm.
it's such a highly leveraged like piece of garbage that any like small tenant issue, the equity just feels an outsized amount of pain, and I would just make a case that they're going to have a big one, like a big tenant issue. So, like to say it has negative equity value would be like generous.
Yeah, no, 100%. And I kind of mentioned this, I guess, last night. Maybe you and I were going back and forth a little bit, and there's again, for those that can't go short or kind of looking for some longs. I mean, there's some good longs in that universe right now, Rob, and you mentioned them on here before in terms of um, again, I'm not in particular order, but just OFC, AMT, Stag, Eastern. What is that? Is it EPG or EGP? I always forget.
Yeah, EGP. That's
EGP, yeah, East Group,
East
right?
Group. Yep, yep.
Yeah. So again, I mean, all these ones with solid cash flows, good balance sheets, and I think that's something to be. You can, if you can go long short, you can put on those Invitation Homes and MPWs on the short side and kind of go along those some of those. Are there any other ones that in the last couple of weeks that you would maybe throw on there? I know from a strength standpoint, I don't think you cover O, but O's definitely been pretty darn strong.
Yeah, some folks like O better than NNN. I think
Okay.
NNN is a better capital allocator.
Sure.
Just it's smaller, so it doesn't really have that style factor going for it. But
Yep.
it's actually, for what it's worth. And I covered this a little bit when I did MPW, but with these triple net REITs, you have to understand that the power of compounding on internal rent escalators is really kind of like the value proposition here.
Mm-hmm.
And when I look at O, they deploy so much capital so aggressively. It's kind of like it's kind of like the bull market option, right?
Mm-hmm.
Like they never really catch the benefit of internal compounding because they're constantly like raising capital and putting it to use. Whereas NNN is, to me, is like a much more disciplined capital allocator and kind of like more the bear market option,
Sure.
that lets its own like internal economics kind of take over and drive returns. So that's the only reason why I prefer it. But some people would push back on that and say like, oh, well, like O's the more high octane option. I would just make an argument that that's not what you want right now.
No, exactly. It's not, which is why I really like. I mean, all the ones I mentioned, like when I pulled up OFC, Stag, EGP. I mean, they're just AMT. I mean, they're just a beauty. Like AMT has gone basically again. I mean, sideways is okay in this market,
Yeah, yeah, exactly.
and depending on if you're diligent in terms of like patient in regards to your entry points. I mean, you could have easily made money in AMT in the last 3 months. So yeah, it's a good. Yeah, you've had some great call outs, Rob. So both on the short and long side.
Thanks, man.
Yeah,
Thanks a
man.
lot. Yeah,
Yeah.
it's hard right now. It's really hard to find longs. It's
Yeah.
really really hard.
Yeah, I can believe it. In terms of just again, just where you're an analyst, Rob, from a Q2 earnings standpoint, is there anything that, again, without giving away kind of behind the curtain type stuff, but
Yeah,
anything you guys are other working on as a group, at Hedgeye in terms of just kind of trying to prepare for sort of Q2 or kind of going out to Q3 or anything from, again, you may not be able to speak to that, or anything from your sector that you're sort of looking forward to, either from a negative news coming out to kind of reassess and kind of look at these longs, kind of a valuation standpoint or what have you.
yeah. I don't know if I could speak to as a group per
Sure.
se, but maybe kind of keeping it in my own coverage, so I don't speak out of
Yeah.
school here. Um, you know, I was pretty bulled up over the past 12 months on the resi space, and like for people who've been paying attention, I've been sounding a more cautious tone, um, for a variety of reasons. Like, it's overowned. It's a B. It's a consensus long, and I'm talking across apartments and single family. Like when I was at Nareit, for example, talking to the REIT long only guys, like what I keep hearing is, well, what else can you own here, right? Like what's the better option? It's kind of like where we need to be because it has like the best growth trajectory, best balance sheets, best everything, and like it feels. I know we hate the word feels, but one thing's for sure, it's a consensus long. And what was interesting to me was when they were coming out before the conference, and like this is where like the math comes in, right? So like they're coming out and they're all either saying we're trending towards the high end of guidance, or we're like raising our guidance for 2022 slightly, and the stocks were just performing like shit. It was like the market was just like did not care that things were getting better, and like I took that to mean like the market was starting to look through towards this rate of change peaking and then rolling over, just because the growth is going to slow. And at the same time, it's a very consumer driven sector, right? Like when we've talked about how bearish we are as a firm on the consumer, it doesn't get much more consumer than resi, and maybe self storage after that within the REIT space. So something I'm like increasingly bearish on, particularly among the Sunbelt names. And I think if they report and you start seeing like that kind of like that narrative out there, well they beat but it wasn't enough, and the stocks start rolling over. I think that's more like the market just pricing in topping out earnings essentially on a forward basis, if that makes sense, or like topping out growth essentially.
Yeah, 100%. Jimmy, I know you jumped on talking real estate, but
Yeah, Jimmy knows his stuff.
yeah,
What's up,
exactly.
guys?
Hey, man.
Just want to say it's been a couple of weeks, man. I miss you guys. I've been playing a different game, so to speak, but I always appreciate the insights. I think Rob hit it head on. Like, if you remember Navy, like the apartment guys started rolling over in April, March, April, right? There was that week where even the winners were losing, some REITs among them, and everything went bearish trend. Like, some of these names are down 33% from their February, March tops. And so a lot of the dedicated guys I talked to, they were trying to out narrative one another, and they're hiding out still, right? But the fact that even as numbers were kind of at a crescendo, we saw the great mark to markets. Markets didn't care then. The generalists already got out, and I think second quarter is typically a really pivotal one for all the REITs because it's put up or shut up, right? If you're behind on your earnings and you're not going to make the year, it's hard to catch up in the back half. But I don't know what's going to happen, but I have a feeling like we have already seen the peak, and it's only going to be more and more people coming to that realization and then trying to get off the same trade. So it's well, yeah, we'll see.
And it's not consensus on healthcare, and like
Yeah, totally.
yeah, and what you want to do is like hide out in the medical office building space, like MOBs, hospitals, excluding MPW because it's a dumpster fire. Like you're going to see this rotation into like the under-owned, like lowest beta, like lowest octane vehicles. Like and that's one of the reasons why we've been long HR. Like HR is a perfect example of that.
HR is like an underweight 5 years out of 7 because they
Oh
just
my
clipped
god,
the coupon,
with
right?
with like a 14% short interest. It's
Yeah,
ridiculous. Yeah.
but you kind of want to be there because no one else is there right now.
Yeah, it's a good call out, Rob. Any other ones that like up the? Have you published? Sorry, and if we don't need to get into your coverage list, obviously, but
Yeah.
did you go? Do you officially cover HR now?
Oh yeah, sure. It's
Okay.
it's been on my my best idea list for probably on the long side for probably like God 3 months now.
Okay, great.
Yeah. So I've been vocal about it, and it has a couple catalysts, right? Like there's a lingering well tower offer. There's the chance that the deal with HTA, which is pending, goes away, and the market's like really kind of pricing in the probability that like that deal does not happen. And HTA like gets both the termination fee, but also like an elimination of the dilution that was priced in post announcement. So they're kind of like two upside catalysts there, in my opinion. And I've been saying that it almost without any work, it's a low $30 stock. So yeah, but it is on there for the record.
Awesome. Yeah, you're right. Sorry, I had that in my notes. HR, NNN, OFC for those. Those, I believe, your top 3 longs as of as of the call the other day. Go ahead, Jimmy.
Yes,
Back
sir.
to
Yeah, I got a question for you, Rob. What are you seeing in the private market transaction?
Am I am I the only one losing Jimmy? He's kind of breaking up on me.
No, Jimmy. Yeah, Jimmy, you're breaking up a little bit, but I think he was talking. He was asking a question about the private market, Rob, and if you've done any
Sorry,
work in there.
they're always kind of fickle. But yeah,
No, you're
private
good.
market transaction volume, like people trying to re-rate deals now.
Yeah, I guess it depends by subsector. I mean, there's nothing going on in office. Well, is there? Well, let me take a step back. Is there like a certain subsector you're thinking of, like specifically, or?
Not in particular. I'm not sure about all the sectors you cover, but it seems anecdotally obvious that like transaction volumes are down a ton, so there's not as much recovery. So I wonder, like, I wonder what's the flow through to the public equity side.
Well, I think the public equities are just like kind of and have been front running it, right? Like we kind of saw it, second week of January, everything rolling over. It's like that classic, the public markets getting there or predicting where the private markets are going to go before it happens. So yeah, it's definitely slowing down. I mean, I think the transaction volume on single family rentals has definitely slowed down for sure. But yeah, it's across, like the cost of capital's up, volumes are down, and to the best I could tell, the public markets were just like kind of predicted that or front ran it.
That's a good point. Yeah, there's that value trap earlier in the year. Like a lot of the higher quality names started trading at these wider implied cap rates, and I just kept on hearing everyone say, "Oh, look at these companies! They're trading north of like a 5 cap, and the private market's a 4.5." And it's just like that's the market.
Yeah, private market was wrong. Like we've seen it before. It happens. It's like office, right? Like the public markets have been right. We're like 3 years early in calling it right. That the private market for office transactions was like grossly overvalued and overpriced and likely to fall. So the one that was kind of like, I think, caught a lot of people offsides, obviously, was PLD. It's kind of like one of those things you really can't handicap. I think myself, I don't want to speak for Jimmy, but I think a lot of investors have a great deal of respect for like what PLD has built. But the reality is that like you don't want to be at this point in the cycle offering 100% uncollared equity at a peak multiple, going into a quad 4, and they didn't back off that at exactly the wrong time in the cycle, and the market punished them for it. So and like, so again, like the Amazon thing has slowed down for sure transaction volumes and the in the industrial market as well. But that was one that I think caught a lot of people off sides, obviously, myself included, by the way. Like it was almost impossible to really see that one coming, because usually they're pretty smart guys, and for whatever reason they just, like, whether it be hubris or whatever, they just didn't back off it, which was surprising.
That's a good call out. I mean, really since 2015, 2016, like you'd lose your job if you were underweight PLD.
Yeah.
Premium cost of capital. I was always in the smaller cap names that are now being taken out by PLD. But the e-com train was a big one. But maybe just because they had such a premium cost of capital, they really felt like they could do whatever they wanted, and they had to.
Yeah. Well, it was weird. They didn't do like kind of what they did with KTR and with DCT and LPT. They didn't flex the balance sheet in their strategic capital platform. Like for those who don't know the story, they have this huge bucket of third party capital that they manage, and a lot of times what they'll do is they'll buy a REIT, they'll buy like a huge platform, and then either kick in cash up front or like sell down some of the assets off their balance sheet post close into this like third party capital, which basically takes the form of cash in lieu of stock. and they went 100% stock, non-collared, and it like kind of it's similar to what happened before we added HR. It creates this like reflexive kind of like downward loop for the acquirer shares, right? So yeah, it was just kind of like a bad timing. I think poor strategy, maybe like a little bit of hubris, but yeah, just a tough one. I don't think no one saw that one coming.
I mean, it peaked the week of April 4th, like right after the Q1 kind of like March euphoria, especially in REITs. It's quite fascinating pulling up that chart.
Yeah.
Yeah.
Hey, listen, I don't want to
Yeah.
I don't want to dominate the combo, guys. I actually have to get back to the little guy. I'm
good.
baby. Yeah, I'm on baby duty right
now. I was just gonna say congratulations. I know you and I haven't spoken since
Thanks, man.
the new one came along, but huge congrats, and hopefully everyone's doing really well. But definitely it's been what, about 2 weeks now, a week and a half.
Yeah, he's a week and a half old. He's doing well. He's sleeping like a champ. But I really appreciate that sincerely.
Yeah,
thanks.
absolutely, Rob. All right, buddy. Well, thanks for jumping in, and appreciate your insights as always.
Yeah. Thanks for having me. Be well, guys. Catch you later.
All right, so I did pin into the nest here a question from RoboMan 2022. He had a couple of notebook questions. So, boys, if you're other Leslie, if you want to jump on, we can have a female opinion as well. But yeah, so first one was around anyone else using Horizon Kinetics lists for short ideas, in parentheses, deflation and or disinflation. So anybody kind of hunting through the Kinetics, Horizon Kinetics. I'm assuming he's talking probably the INFL ticker and or maybe some of the others. I certainly
You're right. He's talking about INFL.
He's talking about INFL, right? Yeah, perfect. Yeah. Is anybody using that at all? I've looked at it conversely, not on the short side, but to get long, to get to kind of pare down some good, basically some names from a hard asset standpoint. But so I've definitely dug into that ticker in the past. So I would highly recommend using that to your advantage. Trend, do you when you're looking at deflation,
he's asking the other way around. Yeah, I've not used that specific ETF to create for idea generation. I think he's asking that can we use the holdings of INFL as idea generation for short?
Correct.
Yeah, so I have not used it specifically because there are so many other plays that one could use instead of going after those ones. Because I think somewhere in the middle of the week, I did tweet something, and the thread started where I started sharing that companies which won't have good free cash flow conversion cycle would be excellent targets, especially if they don't have decent cash to cover and or have significant large amount of debt compared to the EBITDA less capex on their books, right? So I'm going more on that theme rather than trying to go after specific holdings of an ETF, especially inflation ETF. So the answer to the first part is no. I think he has 2 or 3 part question, right?
He does, yeah. But again, from a short side, Trend. I'll just kind of lean in there. Agreed. I think from a short side, looking at and other side, I will. He brought this up last week about junk or high yield growth and the issues that are going to be happening on the balance sheet, and it was a very good comment. I think so. I apologize for. I think it may have gotten a little snippy on him last week, so apologies, Mitchell. But yes, I mean combining basically two of our components in terms of a disinflationary environment along with folks with a bad balance sheet. That to me is the double whammy that Trend has talked about, that many of us here have talked about. And you can do that. You can use different, there's different stock screeners out there, many that are free, and you can kind of run through, balance sheets, current, basically, well, especially after Q2 is about to be reported. So in the next month or two, you can kind of rerun that, but you can do a lot of different components there in terms of, trying to find, good companies good companies to short that have bad balance sheets and are in kind of the wrong exposure. So, good call out there, RoboMan. The second question he had was around: can group share some thoughts how you plan to position for recession? Are we just treating as a deep quad 4? ? So, anybody want to take that one? Maybe other side, because you like to be doom and gloom. You're on mute if you are speaking.
No, I didn't hear. I didn't hear the question. I apologize.
No, that's all right. So basically, any thoughts on how you're planning to position for a recession? Do we just anticipate it as a deep quad four, or treat it like a deep quad four, or kind of how are you thinking about this sort of new shift to like a recession on the horizon?
No, I don't mean to sound. This may sound Keithish, but I'm not going to change what I'm doing. I'm just going to continue to follow the process, and I will short and continue to short the sectors that I think we should be short, right? Or that the signal suggests should be short, right? So I did add to a high yield short the other day. I'm most likely will remain short tech, Russell, shitcos. I think financials are a phenomenal short, and I think they gave us a great opportunity the other day. I did play BNKD the other day, and it was, I think, down like 7%, wound up closing up 8%, which was a nice 14-15% in a day. I think that, that's a more of a tactical play, right? More of a quick trading play. But I think financials offer a phenomenal opportunity, especially when you consider zero deals being done in the high yield space, very little being done in the new issue IPO space. Yield curve flat. I mean, the only area of financials that grew last quarter with J.P. Morgan was consumer credit, right? And that's not going to carry a balance sheet. So, not to mention, as Keith Hedgeye would point out, the hardest, most difficult comps in history, arguably. So I think financials are phenomenal short. At the same time, I'm going to use risk ranges and position sizing. So as much as I don't think I'm short enough, I'm still going to follow proper risk management, scenario. You probably could just, I won't, you probably could put some shorts on and just outright, leave it and stay away, but that's not what we do, right? So we keep our eyes on it and we touch it and we make sure that we've got that, got it covered from a risk management perspective. And we don't shut our eyes to things, even though we think that that's what's going to happen, because the signal might turn. But yeah, I'm going to be pretty short at the right times, hopefully.
Yeah, good commentary. I think that's that's exactly right. I mean, no real need to change anything. It just could adjust in terms of how long you have the position on, right? So we've been thinking, or the data was suggesting that sort of quad four through Q1. If we hit a recession and it's a longer prolonged recession, maybe that goes another quarter or two. I think just time will tell as that data flows in. But yes, I mean, to your point, and this is probably a good segue and one where we can kind of open it up a little bit. But the timing of the market obviously is very challenging, and it really depends on the horizon. I touched base on this a little bit last week in terms of you got to kind of understand how you play the game, what's your MO, what's your portfolio, how's it positioned, what's the direction, are you going to be in and out consistently, are you looking for the big winners, or what's the kind of what's the theme, right? So the other side, you made a good point about certainly on green days, layering in some of your shorts, similar to what I mentioned on gold. You can kind of do a similar thing on many of the financials, or even sort of some of the commodity related exposures, like a URA or a COPX, for instance, right? You can kind of layer in slowly some of those. And again, it's not, I don't really like using dollar cost averaging, but you can kind of basically DCA it on the short side. And it's likely that we're going to be running into a number of challenging quarters ahead. So positioning accordingly could be appropriate. Trend, Jimmy, Chris, you guys got any other commentary around sort of positioning for the shorts, or kind of thinking through not just next week, next month, and sort of the end of the year, or Q1 of 23?
Yeah, I can add some, right? So almost since the start of the year, I've been fairly maintaining a pretty decent size in cash. So from a recessionary standpoint, there are three things I'll be watching for. Number one, I've shared this in prior spaces too, that in a typical bull market, you're flat or long, flat or long, flat or long. In a typical bear market and recession, you're going to be flat or short, flat or short, flat or short. So uh, at the point of the right complacence, right, when we get our wicks in the 24, 22, 25 kind of bucket, accumulating shorts with high convexity, maybe put verticals, maybe some, with defined risk. So that way you're not shorting something the other, and the next day it gets bought out and you're in the hole for 80% or 100% if it was a shitco biotech stock, right, which suddenly got bought out. So from that standpoint, risk manage or define risk, short positions, with good catalysts in mind. For instance, one of the big catalysts that's coming up is the earnings season. So from that standpoint, timing some of these put vertical options or even your short positions, uh, having those catalysts in mind would be extremely beneficial. Second part is I mentioned three highlights, right? The first highlight is decent amount of cash. Second highlight is opportunistically during complacency, kicking in these shorts, because I think in January in one of the spaces I mentioned that my goal this year was primarily to um, survive. Now, with some good luck and with some good research from Hedgeye team, from community in general, I've had a good year. But broadly speaking, and I do attribute, you know, luck also being playing a part in it, because um, it's not just when I win, it's not just that hey, I'm good at it or whatever. There's definitely a luck portion to it that happens, especially in financial markets, especially in a game in which you have to make so many decisions, right? So I definitely want to call that out there. But yeah, playing tactical shorts and much more active handling. So that was second point: active management and tactical shorts. And on a intraday basis, I do whenever complacency kicks in, right? I do take some very short term intraday long kind of positions too. And these are not indulgences, these are just trying to look at some short term trends, but they form part of a satellite, right? So if you look at the core satellite approach, broadly speaking, the core has significant amount of cash. The satellites have uh, allocations based upon what those strategies are supposed to do. Each satellite is a strategy, right? There's a merger up satellite, there's a satellite, there's an earnings satellite, so on and so forth. And I'll share the picture of that in the tweet nest. So that was number two. And number three, purely from a recession standpoint, if I survive this year without a drawdown, I think I would call it a win, because things are hammering right, left, and center. Right, one of my most conservative satellites is merger arb, and the kind of widening of spreads that's happened in merger arb is almost like March 2020. And this is, we are not even at March 2020, and still we're having that kind of wide spreads. So there's a massive repricing of risk. I wouldn't be surprised for a day when we get some absolute inundation of selling uh, in the next uh, in the next 10 to 12 weeks from now, that would create some sort of deeper drawdown in which people would just hate investing, right? People would be like, I don't want to do anything with the markets. All my hard earned money's gone, or whatever gains I had are gone, or let me take whatever is left from the last 2 years of gains or 3 years of gains. So that would be a good opportunistic time to deploy some cash for, especially for some good blue chips. But I'm not in a rush at all, uh, because as Mitch mentions, right, it's a sickness that some people have to become extremely optimistic or keep thinking that, oh, this drawdown will just go away if I keep ignoring. And he puts it much better than I do, so I don't want to I don't want to reduce the impact of the way he says it. But yeah, that would be my third point, that surviving and making sure that I don't get a huge drawdown. Those are three ways of investing during recession. Also, trying to target some income opportunities, be it from merger arbs or be it from dividends or from cash nav SPACs. When I say cash nav SPACs, these are very conservative strategies. They give you 1 or 2% yield, 3% yield max, but you get some sort of money flowing through from your portfolio instead of a drawdown. But you should know what you're doing, meaning you should be able to call your broker and get it redeemed before it converts to the stock. Otherwise, you could have a 50% drawdown. So, those are primary three aspects of investing in recession from my standpoint. Now, if we pivot to quad three, I think everyone would be underowning tech. Something to keep an eye out for from a signal standpoint, from a overall broader trend standpoint as well. Because recently we heard about Zoom on one of the morning calls, that Zoom was kind of giving some interesting relative trend. So kind of keeping an eye out for that broader quad three kind of situation. But before that, we will get ample opportunities, especially on the consumer name side, where significant drawdown has not happened. So with that, I'll give it back to you, Rob.
Yeah, good commentary. And I shared a tweet today. A gentleman, or a person, I should say. I don't know. I don't know who he or she is, but 14 Echo, shared basically his quarter to date gains, or sort of returns, excuse me. And they're flat to slightly positive, right, with S&P down about 16%. So that echoes your point, and something like that. Thousand Air Effects certainly tweeted as well, just the congratulations. And we've said this a number of times across the panel up here, or the speakers, in terms of, if you can finish off the end of this quad four, whether it's next quarter, this quarter, next quarter, 4 quarters from now, whatever it might be, if you're flat to slightly up, you're going to be a big time winner, and you'll be able to take that capital that you worked hard to preserve, and put it to use, and allocate it to some really special opportunities that should be hopefully pretty big winners. But Jimmy, you got a question or a commentary, buddy?
Yeah, just a question off the back of what Trent was saying. Like, amazing points. I thought it was kind of interesting that all of us latched onto this Zoom comment that Keith made earlier in the week. Right, there's a handful of names that have made a higher low, that have consolidated, or they've done whatever. And this earnings season is going to be really interesting to watch, because there's still companies that are trading substantially above pre-COVID levels, with earnings perhaps to be revised down. And then there are other companies maybe with similar commentary or different commentary, but like maybe it's sell the rumor and buy the news, right? There's a couple of these really, really completely left for dead companies. And so I don't know that it's a permanent quad three pivot. We're going to be in this kind of not a great situation for the balance of the year. We'll see. But I do wonder, like, Trend, like what you're like on the fundamental side, if anything, like what you're listening to, and when you watch some of these stocks react, I wonder if there's anything that would change your mind about taking on more risk, or pivoting to more flat to long instead of flat to short, that we've been in this, for the last, let's say, more than half year.
So two parts. I think on the fundamental side, I'd want to see volume growth and pricing power, right? But most companies are not coming through with that. For example, just today, Restoration Hardware, and I shared it in the tweet nest just half an hour ago, gave a 2022 sales guidance that they're not going to be able to meet their earlier sales outlook, and they guided lower. The stock got hammered, down 7-8% more in the after hours and bleeding. So even a good company like Restoration Hardware is not sure about the volume growth, and they were kind of dependent on the HELOCs and people tapping into their home equities, rising home prices, etc., because that's how people fund their $100,000 purchase of restoration hardware furniture, generally speaking, right? With economic outlook going down, it's hard. So, be it consumer discretionary, be it tech, in tech primarily, to answer your question, I would be looking for volume growth and persistence of the management from a pricing power perspective, and market share. If those three things are not held or gained, then they don't qualify. Which at the moment, unfortunately, a lot of companies are not qualifying. Now, on the technical side, because it has to be a combination of fundamental and technical, right? That's why we call it quantamental. So on the technical side, there's some very specific um, mechanisms with not just the price volume volatility, but also time that matters for the base formation, or a sort of under ownership, as you said, or a sort of ETF inflows that would result or translate into some of these stocks getting a bid as compared to anything else. Now, keep in mind, just to give you a recent analogy, if you look at what happened with the Chinese tech stocks, people literally said China is uninvestable. JP Morgan came out with that statement. Then they realized that was stupid of them. So they reversed, they backtrack on that. Um, and the pain was so intense. Look at Baba, right? Look at um, NetEase, look at Pinduoduo. Some of these companies were hammered, like you said, left to die on the vine. um, that kind of situation is very good if you have the right fundamentals. And then you're looking for the inflows to come in on a sustained basis later on to for that to give you the buy the dip and going flat to long. So fundamental side, I want to see market share gain. I want to see volume gain. I want to see pricing power persistence. And on the quant side, meaning just the price side, I want to see price volume volatility in addition to flows supportive for that specific stock, meaning which index is it a part of, what ETFs are tracking it. I usually keep track of top 30 ETFs or top 20 ETFs, or for a specific stock, just top 10 ETFs, or what kind of flows are coming into that specific stock. That tends to give me one of the multiple factors that I look out for from the technical side. So I hope that helps.
Yeah, that was really helpful. My last follow-up is
Hey,
did you play any K-Web today?
Sorry,
I bought the dip a little bit, but
no, before you jump into K-Web, sorry, and so Trent, just on that, because it's a good call out in terms of fund flows, right? So, do you typically use ETFDB and then,
Yes, yes,
yeah,
ETFDB.
ETFDB? So ETFDB is a website for those listening in. That's a pretty common one that will aggregate that information for you in terms of not only fund flows on a typically it's on a monthly, or do they do it weekly now?
Yeah. They even do daily
They do,
wherever
eh?
that's
Yeah,
available. So, for example, when we had that question earlier from the audience about INFL, I was trying to
yeah.
look at the holdings. I think INFL wasn't sharing their holdings on a continuous basis. So on ETFDB, I couldn't find their holdings, which was unusual because they have tapped into all possible sites and sources of these ETF providers in order to get the data. They also tap into all of their regulatory filings. So if the ETF files it over there, then they get it directly. So they're usually up to date, and you'll actually find some very interesting um, patterns in some of these ETFs. For example, when they're giving out dividends, you'll certainly see a huge inflow that comes in and goes out the next day. So almost dividend stripping kind of ETF, uh, fund flow which comes in. And you can actually take advantage of that if there are relatively less liquid stocks in that ETF, and this quarterly pattern when the dividend comes in. You can make good 50, 60 bips with high degree of certainty in some specific stocks, even in the large cap space, meaning even in the S&P 500 space. So yeah, definitely ETFDB is worth looking at, exploring at. You can do more research, fund flow wise or even otherwise.
Yeah.
it's just good to have a handle on who owns your stock, broadly speaking.
Yeah, agreed. Yeah, no, it's definitely helps kind of navigate around, and Chris FX has pointed out too in terms of like the gold miners, right? Like Newmont Mining, which is one of the the largest out there. It's it's one of the few that's held within a wide variety of ETFs, which you guys can look into. Pull it up on ETF DB, and you can see the difference between the number of ETFs, including the SPY that owns Newmont versus like a Barrick Gold or something, right? So two relatively heavyweights in the sector, and it's very, very interesting. And so when those fund flows do happen, Trend, to your point, somebody selling out SPY can adversely impact Newmont, whereas Barrick might not have that same impact. So definitely worth. I just wanted to kind of take a pause there and just kind of dive deeper into that comment, because just to expand on that for folks that are trying to improve and sort of incorporate a lot of the data that's out there. And ETFDB is free. Now a lot of folks use it, so not sure how much of a huge edge it'll give you, but it certainly gives you a better idea in terms of what is happening in the marketplace and how the different flows, certainly from a passive and or trade dated component, how that can influence sort of the underlying components inside of those holdings. So Jimmy, your comment was around KWeb and whatnot. I think we touched base on this earlier in the call, just in terms of kind of picking away a little bit on China. I believe other side may have mentioned it. Might have just been a few minutes before you jumped on, Jimmy. But basically, the answer to your question was yes. Kind of on the down days, kind of trying to put together a little bit of a China exposure. Obviously, kind of being patient to the majority of the degree to kind of the loan to the risk range. But in this environment right now, you're not really getting much of a loan to the risk range.
Right.
So. No, but good question, good comment. Definitely China remains something that we want to be exposed to, and to echo Coach, it would be long China, short Europe.
Do you guys don't know what the trend line is? I think with
on
Investing
the
Ideas or
KWeb?
ETO Pro, the top end of the range was like 34.75 or something earlier this week, and it was getting close there. But and the bottom end was like 29 or 30. I thought trend was like 31, maybe. I could be wrong.
I don't have I don't know if I have KWeb, buddy, trend line, but on trade to me would be around on KWeb. Call it around 31, like 31, maybe a hair north of that, 31.22, 31.24.
Okay,
So,
cool. No
yeah,
need to repeat. But
yeah. But that's kind of trade. Trend's going to be closer in line to where that bottom end of the risk range is. What is it, 29.70, 29.25? Yeah, so it's going to be just a hair above trend, which is exactly, that's the best type of bullish
that's a
signal,
good
Jimmy,
setup.
right? Like if trend maintains above that line, and it almost certainly will, given it, unless it has a big down day, kind of go or kind of finish to the week. But if that low end of the risk range on the trend level is above trend, I mean, it's pretty much as bullish as it gets, and it's making, the top end of the risk range is making new 1 month and 3 month highs again. That's about as bullish as it gets, which means you want a full boat exposure to that bad boy. And sadly, I'm sitting at about 150 basis points, so need to work up. Need to get more of that China exposure. Hey, Thousandaire Effects, I know you're kind of listening in. I know it's getting late there in the UK, but in Georgia, I'll come to you in just 1 second. But anything kind of on your mind or jumping off the page for you, whether it's in the FX land? I know a lot of folks lean on you for FX, but anything else that we haven't really covered yet?
Yeah, on the FX side, the only thing I really hit yesterday was short in the loonie, so short in the Canadian dollar. That might be short-lived because obviously oil's gone back to bullish trend on the pin street, so that might be a relatively short in time position. But that's about it on the FX side, really. But unless you're long the dollar, there's not really much else. I was thinking more like Trend brought up Hong Kong. China's been spoken a lot about. Like the UK, so the UK, the FTSE 100, there's still lots of things that are like super strong and long. Even with over the last week, there's been a big rotation out of like big commodity names, like Glencore has just been almost given up all of its gains for the year. But just on the kind of Hong Kong side, and I know Mitchell spoke about financials, but like Standard Chartered, which is like listed on the London Stock Exchange but has massive exposure to Hong Kong, that's up 42% year to date.
Yeah, that's Standard Charter, right?
Yeah.
Yeah.
So I'm kind of just like I've been saying this for a few months. Is I'm in a weird position for me, and this kind of just more like from a pension side and from exposure to the UK is more so with this commodity shift now is like the FTSE 100 is only down 2% year to date. It's down 4%, 4.5% from its high, which it made on the 9th of Feb, which is obviously completely different to you guys in the US. So I have to make sure I don't screw up getting out of, shifting a lot of things in my pension to go much more bearish or like less long. Yeah, it's just, I guess it's a different, just different problems.
Yeah, 100%. No, it makes perfect sense.
Yeah, because I'm looking like some of these, there's like 10 or 12 that are still got double digit year to date returns. BAE, Royal Dutch Shell, although that's come down. Some of the tobacco, AstraZeneca. Yeah, it's just very different. It's very different. There's a whole lot of stuff that's down a lot. Even with like some of the Russian stocks just got completely delisted and went to zero. But
Russia, what's that? What's that again?
yeah,
Yeah, no, 100%. And the Hong Kong's a good call out. So that the ETF, you can express that in EWH. It's definitely, I mean, it looks a lot like China, not quite as robust on like a full trend standpoint, but definitely picking up some good momentum there. That's for sure.
but at least from our side as well, a lot of the more boring names, a lot of the utilities are starting to get a lot to move up on signal strength in terms
Sure.
of momentum. So yeah, it's not just all about shorting, at least in the UK at the minute.
Yeah.
And just on that point, I'm trying to organize a meet up in the UK. I'll retweet the link. So if people want to put their name down, I'm trying to get a bit of a list of, so I can see how many people might be interested in doing it. I'm just trying to figure out a date, obviously, because people will be going on holiday and stuff. So it might not be until maybe August or September, but we'll see.
Yeah, perfect. Yeah, let's get folks involved over there in the UK, and obviously if you're anywhere in Europe and you want to join, you're always welcome. I think it's going to be kind of a not impromptu, but certainly not necessarily a Hedgeye specific event or Hedgeye sponsored event, right? But certainly something that. But yeah, it should be a lot of fun, and I think there's a few folks trying to do that around the country. I know Hedgeye's putting on the official kind of 1 day event in LA. But I do believe there's some folks that like I'll be up in Canada, north of Toronto, the end of August. So kind of looking to do a similar thing and just kind of get together with some folks, across the border and that kind of thing as well. So so stay tuned, stay posted. But yeah, good job, Chris, and thanks for sharing
Yeah,
those.
I think there's already, I think there's a guy from Germany and a guy from Belgium that have said that they'll come over for it. So.
Oh, sick! That's awesome. Yeah, that's
Yeah.
perfect. Awesome. Yeah. So, if you, I guess, long the UK, short Germany, short Italy, short Poland, short Finland.
I am a bit miffed, and I'm trying to scan through if there's anyone from Hedgeye listening in. In the macro themes deck, you had Germany, France, and Spain. All the quad details and everything at the end of the chart deck, but nothing for the UK, and we're like long and strong in the
UK. Oh man, no love for the Brits.
No love.
No love for
That's
the Brits.
That's it.
Well, speaking of no love, there's no love for Canada either, and we got George coming in from Montreal. How you doing, buddy? You're on mute.
Hey, hi, how you doing, guys?
Hey, doing well.
I,
Welcome.
I've been listening in and out. I don't know if were you looking for trend on KWeb? Did you
Sure.
get
Yeah,
that?
yeah. That was Jimmy. Yeah. What did
Yeah, so it's 29 and a quarter to
29.25?
34.75, the top end of the range.
Thank you. 29.25.
I don't know that we'll get there though, but you never know.
Yeah, who knows?
It feels weird having all this China exposure.
Yeah.
Yeah,
Yeah.
clients. Yeah, it's a very uncomfortable feeling, right? You're like, no, trust me, it's gonna work.
don't let your past performance influence future returns, right, George? Yeah, no, I was having a conversation like that at the lake over the weekend. They're like, but they're communists. I was like, don't let what they do or don't let anything else influence you. Just look at what, have exposure to areas that have really good signal strength. And China's got one of the best in the entire global.
Yeah, for now.
Global world, exactly, for now.
Yeah.
And it could shift on this call next week if something
Yeah.
happens, right? And we'll pivot with it. So
yeah, I hope it's been a struggle this year. Well, just people are antsy to get invested, and then you're like, yeah, this is the best I got, and and you're like, I hope I don't get egg on my face with this one because I might have to cut it very quickly if things pivot. So we'll see. Anyway. Yeah. Anyways, I'll just jump off.
No, it's all good. No, thanks.
Cool, man. Thanks.
Appreciate it, George. Always a pleasure.
All right.
Yeah, Wasim, welcome. Did you have a question or commentary?
Oh, no, I just want to say I live in Canada, so whenever you host that little meeting, I'll be there. That'll be
Perfect,
awesome.
man. Perfect. Yeah. So my folks have a place up on Lake Simcoe. So I think Scott Newman suggested. I believe he's in Barrie, so maybe Barrie or kind of just north of Newmarket there.
That's awesome.
Yeah. Anyway, so kind of right. Yeah. So we'll kind of do something in that general neck of the woods, and just try to get together for a lunch or some drinks or something, and keep it casual, but should be a lot of fun. It was one of the best parts of Hedge Eye Live was just being able to put kind of the names and shake hands with folks from all over the world, right? Which is at Hedge Eye Live, and definitely really really cool experience, and certainly one that I'm excited to to do later this summer in Canada, and obviously Chris is doing it in the UK, and maybe there'll be some more, right? So should be a lot of fun.
Yeah, wicked, man. Yeah, look forward to it.
Awesome. All right, well, we're running in kind of an hour and 15 here, so an hour or I guess almost an hour and a half. But yeah, I mean, we can either reset the room a little bit or maybe just wrap up for the day and kind of go get some dinner or what have you, hang out with the family. What do you guys think? All right.
Yeah, I think we didn't discuss crypto today, right? Chris, do you wanna
do we ever discuss crypto, Trent?
I'm usually leading the charge, even though I'm not invested.
Yeah, Chris, do you want to bring up some crypto assessment from your standpoint? Because from it falls in that forex/commodity and trend following bucket. So you're our expert here.
Don't give me that. Don't put that shit in my bucket.
Okay, fine.
Yeah, I was gonna say,
No,
it's a little loosely. Chris is now going to be a crypto guy. I love it. Everything he dreamed about.
No, so just for the audience, right? Just for the audience, Chris has some very interesting strategies. So, for example, once he shared with me an insight that if you have back-to-back quad twos, then you take the most volatile and speculative asset ever, so crypto and all the altcoins and shitcoins and whatnot, and that gives amazing returns. And when I was trying to do that study, I was like, yeah, that's right. And he also shared his study, privately, but that was an amazing insight, right? So when you own crypto and when you don't own crypto, or when you even short crypto, can actually add so much juice just at a 2% exposure in your portfolio that it's mind blowing, right? So that's why
I respect those kind of insights, so that's why I was inviting him
I
to
mean,
give some
yeah, like
commentary.
honestly, the crypto thing for me was it's like a digital option. Like for me, it's on or
Right.
off, right? I'm not. I was in it. I did okay. I'm out of it, and that's it. I'm not touching it again until there's a point.
Right.
As I guess as we've talked about, tonight. It might be in 3 months. It might be in 12 months. Who knows? But if when we come out of this, the base effects, just as we're saying how bad they are to the downside, there'll come a point where there will be a string of instead of looking at fours and threes, you might be looking at a string of twos and ones, right? So that's what it is for
Right.
me, and it's about how you shift the. I guess the whole point of people having a lot of cash is that in quad four you should have a big allocation to bonds. So right now, because you can't buy bonds, you have a position in cash. Whereas it
Right.
flips obviously in Q2. So whereas the way that I played it was I didn't want to be short bonds or short XLU as an example. So I just went long and was careful with it. But the biggest pieces of crap with all of the stories and none of the liquidity, and was just really careful, and just when things went up 20% in a day, I just took profits and that was it. I didn't care. It might go up 20% tomorrow, but I didn't care. It was okay. I managed to get something out of it. I took the win and then just waited for the next setup. That was it. But that was, I mean, to say it might not happen again, because obviously just as everything's being laid out to be bad now, 12 to 15 months ago, you had Keith on the macro show every day saying this is going to be the biggest positive in GDP growth and the biggest growth rate of change in growth that we could possibly ever see in our lifetimes. So the setup next time might not be the same. It's just I managed to be lucky and took a swing at the time when it was sitting right there.
Yeah, when it moved from 10 to 60.
Yeah.
But no, you're spot on, man. I mean, and again, every quad's different, every setup's different, and you got to be nimble, right? And so BTC is, if it hits 3,800 again, doesn't mean it's going to be an automatic buy, like it was in March of 2020. It just means it's something that you got to be cognizant about and understand, where it fits into the overall portfolio allocation, or if it does at all, right? And that kind of thing. So, it's a very good point. Jimmy's got his hand raised, so go ahead, buddy.
Yeah, I just had a question. You mentioned back-to-back quad twos. What if you're a Chinese investor right now, right? You got quad two in your local regime, but you're dealing with a bunch of quad fours elsewhere. I wonder, and maybe they can't buy crypto, but I wonder how the globalization of risk taking impacts the back test. But I also thought I was kind of curious that in spite of the liquidations, the leveraged margin calls, Bitcoin's held at 20,000 and right at kind of like the Maginot line, right, between Michael Saylor and some larger funds. There's some special numbers out there, and maybe it's just random, but it's been at the top end of the range. It hasn't really, it had that big fall, obviously, and maybe it still goes back down to 10. But I do wonder over the last couple days, it's decoupled a little bit.
Jimmy, are you long Disney?
No, I'm not. I'm only long Ouster. You guys know that in Playboy.
Oh, we can hear. I don't know.
It's the new Baymax.
Okay,
that came out. Okay,
yeah, we can hear some Disney show in the background or something. But yeah, no, I mean, like to that point though, Jimmy, it's a good question. I mean, back-to-back quad twos in China. I mean, just to echo Chris, I mean, you basically want to be long the biggest Chinese crap, right? If you really, again, if you want the juice, right, it doesn't have to be 6% allocation, but to Trent's point, to 1-2% allocation to some of the biggest crap, especially on the consumer side. And so I mean, they're almost about to experience what we what we came out of in terms of lockdown and stuff like that, and they just stimulated blah blah blah, right? So they're in a completely different environment. Chris and I actually spoke this morning, and we were talking about because we were actually reviewing some of the UK data and the holdings and stuff like that from the FTSE together. And that's one of the questions that we came up with, Jimmy, was okay, like how much of an impact do negative quad environments globally, or certainly in a big economic player like the US, how does that impact or influence from either a sector standpoint and or the back test? And unfortunately, I don't have a good answer. We don't have an answer for that. Chris actually tweeted and tagged a couple of folks at Hedgeye, but I don't think it got much airtime. So maybe they come up with some of that data for us, Jimmy. But I don't know. I don't have a good answer. Anecdotally, I'd say obviously a U.S. consumer demand slowing would mean manufacturing might be taking a hit in China, which is why I made that comment about more focus on the consumer aspect and the internal consumer goods, but again, that's just purely anecdotal, and I kind of yelled at other side last week for doing that, so I'd rather stick with the data.
I think Jimmy as well, just like from the China side, because I've said it wasn't my initial idea. It was actually from a contributor in one of the forums for Real Vision, although we don't really talk about them anymore. But the link with Bitcoin and Japanese yen, it might just be completely just a complete coincidence, but some of the levels it hit round numbers in. If you look at Bitcoin and other currencies, I guess say that it maybe Bitcoin versus one, there might be a relative trade, but that then becomes an FX trade, not a crypto trade. Because if you look at things, something like gold in Japanese yen is up 20% year to date. I think it's up 13% against the pound. So if you're a gold owner, a physical gold owner, not via futures denominated in dollars, then your gold is up. If you're living in the UK today, like 13% year to date, but it's flat year to date, obviously denominated in dollars. So I guess yes. On a relative basis, because like quad two, back-to-back quad twos in China, they'll feel that from a consumer side on that side. But it gets back to the question of what becomes more dominant, and in that case, it's going to be the dollar, which I kind of asked a rhetorical question when I tweeted that, because it's basically the dollar. I can't remember if Keith said it was the one thing he could look at was either the dollar or the US 10-year, and he could say, but it's going to be driven by the dollar. I think at
Hedgeye Live, you said if you could have just three things, it was the dollar, the 10-year, US 10-year, and I believe gold, wasn't it?
Don't know, but yeah, it's I guess it's just going back to that question of what's most important, because the question came for me was what's more important, the UK quads, because they've changed recently to back-to-back quad threes, and the quad three is worse in the UK than a quad four. At least from the back test that I've done anyway, but it's mainly driven by the dollar. So it's one of those things. It's like quad four, I think, kind of comes down to the V, where it is very much driven by the dollar and rates driving quad four. And then just like we saw in quad two, it's like, I can't remember how he described it, but like, what did he, like spreading the wings, like in quad two, the basket of things that you can look at just completely widens out. So although something like crypto in the Chinese market might be interesting, it's all going to be driven by the dollar, because the global quad four is still in and the dollar is still strong.
Yeah,
good
good
insight.
insight.
So that covers our crypto segment. No, I
well done,
seriously
Chris.
mean it.
Yeah, well done,
I think we
Chris.
should touch upon crypto every now and then on the spaces. In the tweetness I've shared about a Bill Wang like situation that happened in the last 2 weeks. So for folks, I know folks who trade crypto probably are aware because this was all over CoinDesk and most of the other crypto news agencies. But there was a massively levered fund called 3 Hours Capital. They had actually done leverage on almost every exchange possible. They were operating out of Hong Kong. They had the most high beta altcoins with them, including Terra Luna. So when Terra Luna went down, they started getting margin calls from these exchanges. They got liquidated in a bunch of these exchanges. They had also taken loans. So now the creditors are running like headless chickens. For instance, Voyager Digital, which is a famous exchange, crypto exchange in north of US, and I think they're based out of Toronto. They were completely hammered down because of this one big loan they had given to 3 Hours Capital. Long story short, these guys created a Bill Wong like effect when they went down, and they're basically not paying any of the folks, and they're having technical defaults with most of these lenders. So from that standpoint, keep an eye out. I know, Jimmy, you asked about 20,000 mark. It doesn't stop here. It's just going to keep going down. We'll probably hit the 10. We'll breach the 10, primarily because of this tsunami wave or set of waves which have been set out because of this 3 Hours Capital situation. It is pretty massive. It's not even properly covered by the media. For those who want good podcasts, there's a podcast called Unchained. It's pretty cool. If you just want to get familiar with the crypto space in general, both from a trading standpoint as well as from project standpoint. Sometimes they do discuss. There's this person who shorted crypto very opportunistically. His fund's name is Galois Capital, Galois, Galois Capital. You can search him on Twitter. But that guy has shared with the broader masses of how he timed some of his shorts, including Terra Luna, for fairly large leverage on multiple exchanges. So, and I know a bunch of the folks from audience did ask me a question about how do I short crypto. You can short cryptos using perpetual futures. They're available on exchanges such as Binance. They may not be available on Coinbase. You can also short them using Bitcoin futures, but their risk management is not easy because the minimum is 5 Bitcoin notional. That's a lot. But when it comes to Binance, the size of the contract is much more manageable. So I just wanted to touch upon that.
You can get options as well on
Yep.
on what's it called? Deribit and stuff like that. Yeah. So.
Sorry, was the name of the podcast was? Did you say Unchained?
Yeah, Unchained. Yep.
Okay, thank you.
Just another question came up about getting ready for a recession. So this year and I'm doing air quotes, small markets. So just this year already, we've had trades being halted and reversed and reverted because they were done at the wrong price on nickel. We've had it done on crypto exchanges for Luna. Like without doing this whole doom and gloom thing, there's every chance that that could happen on bigger exchanges. That's one of the things. So I guess it's like how far do you go down the rabbit hole, but don't have everything all on any one single exchange. Don't have all your money in any one single bank without doing the banking system's going to come to none of that, but just it's just about as much about managing risk in terms of when you enter and exit a trade as the things that you never, ever, ever, ever think about when everything's going fine are probably going to start creeping up. And as I've said, it's already happened twice. And yes, people will say, oh, but they were on tiny markets. The nickel market is tiny and is cornered by one big guy in China. Okay, that's fair enough. And you could probably say the same, that everyone was all in the same trade, all in crypto, and they were all in the same space, and they got screwed. And that's fine again, but something that's never happened, or not never, but something that hasn't happened for a long time has happened twice in the space of 6 months. So, yeah. So don't go slit your wrist or anything, but just think about what you're doing and and just don't have all of your money in any one exchange, because this kind of stuff can happen really fast, and you might not have the chance to kind of figure it out in time. But yeah, okay.
Yeah,
that's enough doom and gloom.
Yeah, it's.
Sorry, I have one more question.
Yeah, go ahead, Wasim.
Sorry, maybe it's like stupid, but I'm gonna ask it anyways. Interactive brokers, like, this is not a brokerage that people should worry about in terms of, like, like they're like backed by like governments and all that. Like, are they essentially just regulated the same way they're regulated by larger banks? Do you know anything about that?
They're a listed, sure. So Wasim, they're a listed entity. There's SIPC rules regarding how much amount is secured and what are cash position you have if they are not automatically put into FDIC-backed cash account. Then you need to inquire on how to safeguard that. So, for example, in Fidelity, what they do is whatever cash you have, they'll automatically journal it into an FDIC-backed account. So up to $250,000, it's backed by the FDIC insurance. Now, from a standpoint of trade settlement, SIPC has some specific limits and rules. You can research more about that. And if you have larger amounts, I think one of the things what Chris is saying is that, let's say if you have 250 limit here, 250 limit there, if you got $1 million, then have 4 brokerage accounts, right? That way you're not shunned from your capital when you need it most. So that's the point he was trying to make. And keep in mind, bank accounts are covered by FDIC insurance to a certain degree, but from brokerage standpoint, the provider is SIPC. So Sam, India, Petro, Charlie. So just have a look at that, and then you'll get to know more about it. But it's not a stupid question. Many people don't know about it when they trade. It's different for different jurisdictions, right? So I'm assuming you're from US. So for that, certain rules apply.
I'm from Canada.
No, he's in Canada.
I'm in Toronto.
Oh, sorry. Then ignore what I've said. What I said was for US based. I don't know how it applies to Canada. You'll have to find out.
Well, because and the reason I'm doing it is, I mean, obviously I've been trading through TV, but it's just expensive to trade there, right? And I put some money on Interactive Brokers. I'm trading there, and it's so much cheaper. I just want to know how much I can bring over. That's all. I'm just kind of trying to.
Listen, there's similar Canadian rules there, buddy. I don't remember the dollar amount off the top of my head, but yeah, I mean, if you go into your account or some docs, it's very readily available. Just or message the chat line or whatever, right? And they'll let you know. But yeah, it's there's similar regulations, and the Interactive Broker as an entity itself is certainly highly regarded and in that kind of thing. So I know in Canada. I know in Canada it's kind of you got your kind of 5 big banks and sort of Interactive Brokers is somewhat broken into as an alternative there. But yeah, definitely from that perspective, from an exchange or from a broker, nothing to particularly worry about. But again, you never know, obviously. But they're certainly a part of what I'd consider kind of the top 10 here in the U.S.
The top tier.
Top tier. Yeah, top tier here in the U.S.
Okay, that's good.
In fact, keep in mind, Wasim, when that oil futures going negative 37 happened, right? There were a couple of Canadian futures buyers who were compensated because of some systems issue in Interactive Broker. Initially, that person could have been on the hook for almost $800,000 loss, but Interactive Broker took it upon themselves because there was some glitch in the system which wasn't allowing this person to unwind his trade at a negative amount, and that's
Oh,
why they took over the loss. So they are, you can listen to their earnings calls or transcripts as well. They're kind of well intentioned, but you never know what happens. So just to build upon what Chris mentioned, right? I recall this kind of thread happening in 2008. That initially there was some murmuring that was happening, small banks, small savings and loans bank here and there going under, I was actually being trained by FDIC for closing banks, meaning how to close bank in a very systematic way so that there's no run on the bank. This activity is called as seizing the assets of the bank. And there's a specific division called Division of Resolution Receivership. Um, it started out with just two or three or four banks. We suddenly saw a massive default in form of, and this was not on the savings and loan side. This happened more in the investment bank side, where Bear Stearns suddenly went under, and JP Morgan scooped it right at $2, and then later on that would increase a bit to $10 because Bear Stearns was about to go kaput. Then slowly, steadily, everyone thought that, oh, everything is good now. April, May, June, July, and then suddenly in August, everything hits the fan, right? Lehman, Merrill Lynch, everyone is on the block, chopping block, and rest everything is history, right? We know what happened at that time. So, uh, to highlight what Chris was saying, in the last 5 or 6 months, what has happened could be just a hint of the trend that might be developing in the broader economy. And especially that could indicate to you why the repricing of risk shouldn't be ignored. And one should become much more conservative in risk management from that standpoint. So just want to highlight that specific part. He's not doing doom and gloom, but just wanted to make sure everyone is aware that if you have more than a certain amount in your bank accounts, either buy additional insurance or clip it at the FDIC insurance. I'm telling you this because I used to close banks. I saw a very devastatingly tragic story in California. The lady sold her house, which her husband had bought some 20 plus years ago. The appreciation of the house was supposed to be her retirement. Okay, it was $3 million plus. She kept it in a regular checking account, the entire amount. She did not chop it up in blocks of like 100,000. Back then, the limit was 100,000. They increased it to 250 later. And she kept it in this one bank. When the bank went under, she was supposed to get back only $100,000. So it was a nasty experience. And like her, there was literally a line of senior citizens outside that bank in California in 2008. So if you have any bank accounts where you have more than the FDIC insured amount of 250K or any amount with brokers where SIPC insured amount is exceeded, definitely start planning around that. I'm not saying we'll see that day, but it's just a prudent risk management method. Or just buy extra insurance for this kind of event.
Yeah. Excuse me. Yes, absolutely, Trent. It's very good and good. Well, not a good story, but sometimes those ones that hit home are definitely the ones that are. Yeah, that's very sad for that person. But we'll just kind of leave it at that. And Chris, I not that I was mistaken, but Joan or somebody, Mass Bay, tweeted that basically KM did say on a macro show or somewhere that one of the only pieces of data that he would need would be the dollar. That was like earlier this winter or spring. So my bad. I think he expanded on that maybe at Hedge Out Live. But yeah, definitely the dollar. That's all he needed, Chris. So good memory there. I lost that one. Jimmy, why don't we pass it off to you and then maybe we'll wrap up.
Yeah, I was going to let you wrap it up, but I just want to make sure I didn't miss it. Did anyone talk, like, does anyone know if like a fund got liquidated today? Like, I'm seeing a lot of pain in SPACs, small caps. I just wondered if anyone heard anything through the grapevine.
I have
lots of names just like down 10%. I noticed, NASDAQ was pretty flat. It was really just small caps. I don't know. Maybe there's just an observation.
Yeah, I'll echo Chris's quad four, Jimmy, quad four.
No, it's actually quad 8.
It's quad 8. It's it's quad 4 on double steroids. Yeah, I do not have any knowledge, but obviously, if anybody's listening to this or listening to the replay, if you guys got any insight, you're on the desk somewhere. By all means, shoot Jimmy or tag Jimmy or tag us all in a tweet. We'd love to learn more. But yeah, Jimmy, I didn't really see it. I mean, I honestly didn't really look at many small caps today. I was kind of pretty pinned in on the SPOOs.
Yeah, I didn't check the market at all. I checked it at the end of the day. I was like, oh,
Yeah.
shit.
Yeah.
Yeah.
Got it. Yeah, no. Awesome. Well, another good session tonight, everyone. Thanks for joining in. Thanks for participating. Great questions, good commentary. So agree. Thanks, Trent, Jimmy, Chris, for kind of helping to carry the convo, and Wasim. Appreciate you jumping in, man. Looking forward to potentially seeing you in late August up in the motherland, the great
For sure.
the great white north.
Yeah.
And yeah, so awesome, guys, and we'll next week is a holiday week here in the U.S., but I'll be back on was it the 6th? Yeah, the 6th. So I'll look for next Wednesday we'll kick off the Q3. It'll be an evening session, so an 8:30 p.m. Eastern session. I'll send that out in early next week, but looking forward to it. And as always, thanks for your time. Thanks for listening in. Greatly appreciated. I did tweet out, just I'll wrap up here. I think we have probably a few pros and stuff on the call, but I did tweet out yesterday, just kind of seeing if any the interest. And George, I know you jumped up, but interest from, and I see Turtle down there too. Perfect. But interest from any like RIAs or IAs or independents, bulge bracket. Again, not trying to take away the Friday night speakeasy that Jimmy and Turtle host, but a bit more kind of process, I guess, oriented, or just kind of talking about kind of how they run their business. I know, Jimmy, you're getting you're getting your IA kind of book of business off the ground and stuff like that. So again, just didn't know if that might be helpful to have sort of maybe meet up twice a month, or even just once a month, and just sort of have a bit of a group session of kind of how they deploy Hedgeye into their book of business,
Absolutely.
that kind of thing. So
I think a lot of us struggle with that because of the legacy incentive structures, the transaction costs. Like, we're trying to figure out ways around it.
Yeah, you were DMing. Yeah, you were mentioning that. I think over the weekend or on Monday. So yeah, man, it kind of what sort of jump started a bit about in my head, Jimmy. To be honest, you, you inspired me, right? So yeah. So okay, cool. So again, if you're interested, let me know. But kind of probably look for that to maybe start up next month too. Maybe we'll try to give it a go. That's that second week after the holiday week in July, and we'll give it a go and see how it goes. But yeah, but thank you, and if anyone's in Philly, hit Jimmy up. Right? You can't solicit, but I sure as shit can.
Thanks for the shout out, for sure.
You got it, boss. All right, guys, we'll talk to you later, and stay safe out there. Keep that head on a swivel, and those trash cans move, as they say, but it's likely only one direction we're going, and that's Titanic. They're going to hit that iceberg pretty soon. All right, we'll talk later.